Hello again, everyone. It is 9 o'clock in the morning Chicago time on Monday, March 25th, 2024. I'm John Kosar from Asbury Research, and this is your Daily 5. Asbury Research provides investment research services and money management to individual and professional investors. For more information about us, visit asburyresearch.com. You could also subscribe to Asbury Research's YouTube channel to see more of our data-driven approach to investing and money management. Let's begin today with a brief recap of what I was talking about when I was with you last on the February 20th, your Daily 5. We said that a decline below S&P 500 48.45 would have been necessary to indicate that a corrective decline was underway in the U.S. broad market. SPX traded as low as 49.46 the very next day, about 100 points higher than where the support was, and then essentially moved straight up from there. We also said that our Asbury 6 risk management model was on a February 7th bullish signal. It still is on a bullish signal. The S&P 500 has risen about 5.3% since that February 7th signal in the Asbury 6. Finally, we said that continued strength in technology was necessary for future market strength. The reason we said this is because this year's really strong move higher that we've had in the U.S. stock market was largely driven by a handful of mega cap stocks that are tied to AI. Meta is one, NVIDIA is another. There's a handful of those stocks that have really been influential in dragging the rest of the market higher thus far this year. XLK, which is the Spider Select Spider Technology ETF, that has been a relative performer versus the S&P 500, meaning that over that span of time since February the 7th, it's been even with the S&P 500. It's outperformed for several weeks. It's underperformed for several weeks. In our view, we need that continued leadership from technology in order to keep this rally alive. So with that said, let's look ahead into April via my 5 most important charts, data series, and Asbury Research quantitative models that I believe are amongst the most important to be aware of and potentially the most influential to U.S. stock market direction over the next several weeks to possibly into the summer. Let's follow the money. Number one, the S&P 500 bullish tactical trend remains intact above 50.10. So that's our support level that we're going to be watching here. It's primary tactical support. Let's have a look at that chart. We've got a daily chart in the S&P 500 here going back to September of last year. And we've got a 50-day moving average in blue, which is a minor trend proxy. We've got a 200-day moving average in orange. That's a major trend proxy. You can see September, October, we drifted the S&P 500. That is, it drifted under the 50-day moving average, indicating a bearish minor trend change, and even edged below the 200-day moving average in the latter part of October, but it quickly came back. This was the start of that major uptrend that we're still in today. Our CPM model, which is it's one of the 2 tactical in-house models that we use here at Asbury Research. CPM's Correction Protection Model, CPM. That went risk on November the 2nd, right where the arrow is. We got above the 50-day moving average, had a slight retest of it on January the 5th. Our Asbury 6 is a much faster indicator. We're going to look at that in just a minute. Our Asbury 6 is much more fast twitch. It's every day. It's an everyday assessment of what the internal strength of the market, the internal health is a better way to put it. What's the internal health of the market that day? Asbury 6 went back to positive here on February the 7th after some sideways choppiness here, really from the latter part of December through the early part of February. But the A6 went back to positive here, and here we are just off all-time highs. Here's the support level that I think we need to pay special attention to over the next few weeks. The initial support and its minor support is at 51.89. It's the March 8th high. You can see we've had some other activity up here right around that high, indicating the market sees it and thinks it's important. That's 51.89. Primary tactical support is at 50.48 to 50.10. This is 4% underneath the market, and this is the level that needs to hold in order to keep the minor uptrend, which started way back here in the beginning of November, in order to keep that trend intact. 50.48 is the February 12th high. You can see there's been a lot of activity right around that 50.48 area since then, indicating, again, the market sees it and thinks it's important. And coming up underneath is 50.10 is the 50-day moving average. If we broke through there, that would indicate via the price of the index that the market has gone into a corrective period. It's broken the minor uptrend. Major support is down here at 46.07 to 4600. 46.07 is the July 2023 benchmark high. It's off to the left here. You can't actually see the point, but we have the line here to represent it. And 4600 is the 200-day moving average. It's about 12% underneath where the market's trading right now. What does that mean? It means that we could go into a overdue corrective decline in the S&P 500 by taking out 5010 and still have another 10% or so to be able to move down, 8 to 10% to move lower, and still be able to maintain the integrity of the larger major bullish trend. Number two, let's look at market internals. I had mentioned the Asbury 6. The Asbury 6 has been around for a while. I initially built the Asbury 6 by taking my favorite tactical tools that I've been using over my career, which began in the 1980s on the floor of the Chicago Mercantile Exchange, the CME, and back testing them in different sets of 4, sets of 5. We came up with 6 indicators that were pretty diverse, but gave a good kind of under the hood daily indication of what the health of the market is. And those indicators are the rate of change in the S&P 500, the relative performance of stocks versus high yield bonds, investor asset flows in some key ETFs like SPY, volatility, trading volume, and market breadth. 4 of these in one direction or the other indicates a directional status for the model itself. So 4 or more of these 6 constituents have been green in the A6 since February the 7th. That's why the positive signal. I told you that there was a lot of chop going on here in the beginning of the year. You can see there was a lot of, we call it blinking. When you've got the indicator, when the A6 is going up green, down red, up green, down red, kind of in a back and forth fashion, just like we see here. You often see that when the market's at a balance point and it's trying to decide what its next trend is going to be. Well, we had a lot of positive news coming out of the AI space, starting with the second week of January, and that eventually led to this final green arrow up on February 7th. That's where our metric is today. If it goes to 4 red, it's going to indicate to me that the market is internally weak enough to facilitate a corrective decline. We're not there yet, and until we are, we're going to maintain our bullish tactical bias on the market. Number 3, sector rotation. Our SEAF model shows that money over the past couple of weeks has been moving pretty aggressively into energy. SEAF is an acronym. It stands for Sector ETF Asset Flows. It's a model. It's probably the model. The first version of the model was probably six-ish, maybe 7 years ago. What it does is it measures the velocity of money that's moving around the 11 sector spiders, which together are the S&P 500, and it looks at them in 3 different time periods, weekly, monthly, and quarterly, to determine where the money's going, in the sector space and where the money's coming from. Right now, it's moving into energy, and you can see this via the rainbow chart. You can see why it's called the rainbow chart. These are the accompanying charts for our SEAF model. We have one for all of the 11 sector spiders. This is updated every week on the weekends to reflect the asset flows of the previous week. So what we're showing here is that since March the 13th, the energy sector has moved into a favored ranking. That's the green space up here at the top. Favored ranking, that's according to the SEAF model. The yellow here up top is neutral, and the bottom here in red is a void. So what we're looking to do is buy the sectors that are in a favored status according to SEAF, and we want to avoid those that are in an avoid status. So we're always staying where the money is in multiple time frames. So look what's happened here. Really, since the beginning of March, we came ripping out of the avoid space here, or the avoid ranking. We blew through the neutral ranking, and we've been in green favorite territory since March 13th. And look what's happened to the relative performance chart of XLE versus SPY. That's what we have down here. This is the accompanying relative performance chart of XLE versus SPY. So we moved to favored ranking here, and we're starting to see some relative outperformance down here in the bottom panel. Look at here. We had been on an avoid status with very few exceptions since November the 8th, all the way just until a few weeks ago, February 9th, and we had 13% of relative underperformance by XLE versus SPY. On the flip side, back last summer, from let's call it the middle of July here through the middle of October here, with just a couple of brief periods where we moved to a neutral ranking in energy, it's been favored. During that period, look at this nice move here in relative outperformance that it caught. So that's what this is for. It's to show us where the money is going. Just as an aside to this, we're also seeing evidence of money moving into some of the other commodities. We recently put out a buy idea in GSG, which is a ETF that tracks the commodity space. Energy is in there, and many other various commodities are in there. So it's not only energy that we're seeing this, we're starting to see some changes where we're getting money starting to move in various commodities. Even some of the grains are starting to hold some support levels here, corn and wheat and soybeans. So this looks to be, this could be part of a broader move higher in commodities. So we're going to be keeping a pretty close look on that in the weeks ahead. Number 4, chart patterns. The Dow 30 targets an additional 5% advance. Here we've got a weekly chart of the Dow going back to 2019, and the takeaway here is after a great big extended move higher from here in March 2020, this was the COVID lows, up to the January 2021 high, we've had some coiling sideways for 3 years in the Dow. That coiling period ended on D1 of last year. You can see the breakout here in green. Based on the size of the pattern and the shape of the pattern, it targets a move to 41,500. That's still another 5% higher than where the Dow's trading right now. The Dow and the S&P 500 have had a tight and stable linear positive correlation to each other throughout the past 25 years. So what does that mean? It means if the Dow's got another 5% to go and it's going to hit 41,500, the S&P is likely to go up higher with it. So one of the hardest things to do in these type of markets where we're up 24% or whatever it is since the end of October is when's it going to end? Everybody starts getting nervous about they don't want to be the last one on a ship that's starting to sink, that's starting to go the other way. So everyone is kind of doing a lot of hand wringing here, or where should we get out? Should we get out now? I don't want to be caught in the downturn because the market's overextended. This chart is telling us that we could see as much as another 5% higher in the Dow before this move is finished. Finally, number 5, seasonality. April is the second seasonally strongest month of the year. Let's have a look. This is these 12 columns. They represent the 12 months of the S&P 500 going back to 1957 through February of this year. And you can see that March and April, highlighted in green here, are the fourth and second strongest months of the year based on these data. And then we have our sell in May and go away syndrome starting in May, which is the eighth strongest or the fifth weakest month of the year, and then we kind of drift into the September low. So this tells us from a seasonality standpoint, what we're seeing in the Dow 30 chart looks like it could possibly extend through April. We still have seasonality at our back to take us through the month of April and still be able to maintain this uptrend. So there it is. These are my 5 most influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. They collectively suggest that the market may still have some upside to go here before this very aggressive November 2023 advance is over. Our research also indicates that money is starting to move into the energy space and into the commodity space more broadly. While we're looking at what could be an emerging opportunity to trade in that space and maybe be able to capture some relative outperformance in the weeks and months ahead. If you'd like a copy of the PDF from this presentation, feel free to contact us via the contact tab at asburyresearch.com. Thanks for watching. I'll be back here in just about a month with another Your Daily 5 via Stockcharts.com. In the meantime, you could request information about Asbury Research's premium services for investors by going to asburyresearch.com and using the contact tab. Thanks, and we'll see you again in just about a month. Have a fantastic April.